Inflation has been on an absolute tear over the past year. Now, I normally respond with a "who cares" comment, but if this thing keeps going at its current rate, then your money will lose its value a lot faster than it has in the recent past. So the question is, what can you actually do about it? In this video, we'll look at actual data to determine the best place to park your money to protect it from inflation as much as possible. Warren Buffett has been around for a very long time, and he's pretty much seen every market condition that you can think of. So we're going to hear from him on what he thinks you should do with your money when inflation is on the rise as well. And of course, since Bitcoin is always a hot topic, we'll also take a look at if that asset class is as good as an inflation hedge as a lot of the Bitcoin bulls say it is. Inflation is, of course, when the cost of things we purchase increase over time. Now, I think that we all understand that a cup of coffee today is more expensive than it was 20 years ago, or $100 today buys you less than it did 20 years ago. The only thing that seems to be protected against inflation nowadays, for some reason, are Costco hot dogs. They've stayed at $1.50 a pop over the last 35 years, even though with inflation, they should cost about $3.65 a piece. The company has refused to increase the price of that mystery meat wrapped up in a donut. Hot dog bun. But understanding that our purchasing power decreases over time only explains what's happening on the surface. There are so many layers to inflation that we're not going to have time to cover all of it in this one video. Also, not everyone agrees on certain parts of the whole thing either, which makes it that much more difficult of a topic to go through. If you want to get really deep into understanding it on a whole different level, then I'll have a link in the description to an article Lyn Alden wrote. It's called The Ultimate Guide to Inflation for Very Obvious and Very Accurate Reasons. Because it's so knowledgeable, I'll be referencing some of her info throughout this video as well. Before I forget, please do me a huge favor and hit that thumbs up button. It really helps support my dog Molly, myself, and lets me know that you dig what we're doing over here on this channel. The reason prices of items we purchase goes up is because as time goes on, more money is created. That turns into more money in each of our pockets, which means that we have the ability to consume more things, which of course increases demand. If there aren't enough goods out there to meet the demand, then prices will increase. This specifically is considered consumer price inflation. This is the number that we see everyone focused on each month, especially as of late because of the amount of money the government has been spending over the past year or two. Consumer price inflation is exactly what we're seeing, for example, with car prices right now. They're insanely higher than usual because people have the cash to buy cars, but there's not enough cars because of the chip shortages due to shutdowns during the start of the 2020 sickness and supply chain issues as well. When there's more money in our pockets, we also have the ability to invest more money into assets as opposed to, or at the same time as, increasing our consumption. In this case, we'd start to see asset price inflation in things like stocks, real estate, and those sorts of things. This is why over the past handful of years, you've been hearing that investable assets are extremely overpriced. People have had so much extra money on hand that they overbuy assets, which of course drives up the price. It's good to remember that consumer price inflation is going to impact everyone differently based on quite a few factors. I want to call out two factors specifically to help give you an idea of what I actually mean. First is with income. A rise in consumer prices are going to be a bigger deal for someone who has a lower income versus someone who has a higher income. A person earning $300,000 per year in the Midwest can more easily absorb a spike in certain spending areas than a person living in the same exact area earning $50,000 per year. The good news is that the person who is earning $50,000 per year most likely has the ability to increase their income by asking for a raise or getting a different job or even taking on additional work to make a little more cash to offset that increase in prices. Lyn points out in her article that if someone doesn't have a lot of money and lives on a fixed income in retirement, they have a lot more vulnerability to inflation. The retirement thing might not apply to younger people like you and me right now, but it's still something to be aware of so that we can prepare for this type of issue if it arises again in the future. The second factor to know about with consumer price inflation is that it's going to impact everyone differently based on what they actually buy. If you're married with 2 children who you still support, then consumer prices increasing is going to hit you harder than someone like me who isn't currently married and doesn't have any kids, that I know of at least. The main reason is because by nature, you're most likely spending money in more of those inflated categories than someone like me because I have 1 human and 1 Molly to take care of, while you have 4 of those things. Not 4 dogs, but 4 humans, mouths. People. The same idea goes for someone who is currently in the market to purchase something like a car. If you and I aren't in the market for that product, but your next door neighbor Billy is, then he's taking a bigger inflation hit than you and I are because we can't pay higher prices for something that we're not buying. But we need to hear from the man, the myth, the legend, Warren Buffett, on what he thinks people should do when there are high levels of inflation.
Yeah, well, inflation Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate.
So if you can improve your monetary net worth through the work that you do, then it's possible to out-earn the rate of inflation. Something to always remember is that if inflation for the year was 4.8% and you didn't get a raise at work by at least that amount this year, then you basically took a pay cut. Think about that and let it sink in for a minute. I know it really hurts to think about the fact that the overall cost of consumer goods increased, but your salary didn't go up to adjust for inflation. This is why Warren Buffett mentions that inflation is a silent tax. Most people aren't getting yearly raises at the same rate as inflation. In the short term, you don't really notice it, but 5 years from now, you might be scratching your head wondering why money feels a lot tighter than it has in the past, even though the items that you purchased haven't really changed. It's like that one metaphor about boiling a frog. If you put a frog in a pot of boiling water, then it's of course gonna jump out. But if you put a frog in room temperature water, then slowly increase it to boiling, then the frog won't notice until it's too late. You and I are the frog, so we need to pay attention to these sorts of things. Buffett also mentions how to invest your money when inflation is high.
The best investment, passive investment, I think is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency.
You might not own any actual businesses like he suggests, but that's okay because there's other ways to invest so that you can capitalize on what he just said. To show what those investments are, we can take a look at an article that Nick Maggiulli posted on his website called Of Dollars and Data. I'll have a link to the full article in the description of this video. He went through different asset classes to find out which ones performed best during different levels of inflation. The data looks back from 1976 to 2019 and covers asset classes like gold, international stocks, REITs, the S&P 500, home prices, and a few other things. One thing he points out in his article is that some of the asset classes like gold, REITs, and equities have higher volatility than others, meaning that the price can change very rapidly. We all hear that gold is a good hedge against inflation, but based on the data he pulled, that's far from accurate. Not only is it the highest volatility asset, but it also has some of the lowest real returns. Nick drilled down into the data a little bit more to see how each of these asset classes performed when inflation exceeded 4%. Since we're probably going into a time where this might be the case, then this info is extremely helpful. Here's what the returns were for each one. It's still hilarious to me that gold hasn't done too well since the narrative has always told us differently for as long as I can personally remember. But it is interesting to see that REITs have done the best by a long shot, followed by international stocks and the S&P 500. After looking at this data, I wouldn't suggest putting all of your money into REITs. As much as it looks like that's what you should do, I would hold off. It does give us an idea of the type of asset classes that have performed decently well in the past, which means that it might make sense to have some of our money spread among those areas today. S&P 500, REITs, businesses, and physical real estate. Now, you might not have your own business to invest in like it might have sounded like Warren Buffett was suggesting, but you do have the ability to invest in the stock market. And when you invest in the stock market, you're investing in actual businesses that actually make money. Well, at least some of them do. No names, please.
Why would you go after revenue? Because to make money, it's not about how much you earn. It's about what you're worth.
Another thing to note when it comes to real estate is that inflation is a net benefit to someone who has debt through a mortgage. Because if money is being devalued through inflation and your payments stay the same, which they would, then your mortgage will naturally shrink over time. As long as you haven't overextended yourself in that area and you're not quote-unquote house poor, then you should be good. So what about Bitcoin as a hedge against inflation? As of right now, I don't think there's enough evidence to say one way or another since it's still a very new asset that's only existed since 2009. During that time, we've lived through pretty low inflation. Hypothetically, you'd think that it would because there's a finite supply, so that should help retain its value, but who actually knows? I found a chart in an article on Morningstar that shows what the price price has done during previous levels of inflation and federal funds rates. As of right now, I don't necessarily see much evidence that it's a good hedge against inflation. That's not to say that it isn't, but I think that we need a larger sample size to say one way or the other. Full disclosure, I personally hold some Bitcoin as a part of the 10% speculative portion of my overall portfolio, so if it works out, then I look like a freaking genius. And if it doesn't, then that's okay, because it's not going to send me or my dog to the poorhouse. I'd like to point something out when it comes to the inflation rate that's reported. After learning more about the official number from smarter people than me and how its calculation has changed over time, I tend to fall in the camp that the actual inflation rate is slightly higher than reported. I don't think it's 6 to 10% higher than the reported number like some of the tinfoil hat people say, but probably a little higher than what they officially say it is. All this inflation rate talk could potentially make you feel a little discouraged, and if that's the case, then I apologize, because that was not my intention. To be honest with you, I don't like making a lot of these current event videos because 99% of the time, they don't matter to long-term investors, and I feel like I'm out here almost fear-mongering, which kind of makes me feel like a bad person. But I do think that we're going to start seeing a little uptick in the average inflation going forward, so I wanted to give you my thoughts on the whole thing. The good news is that as long as you continue investing regularly, consistently try to grow your income, and focus on the things that you can control, then everything is going to be just fine. I'm personally excited and motivated to do what I can to put myself in a position to where the inflation rate is irrelevant to me when it comes time for me to live off my investments. Always remember that attitude is everything, especially if we're talking about things like the inflation rate that are completely outside of our control. So stay positive and keep going. A 3-fund portfolio is a great way to hedge against inflation, so check out that video to your left next. Make sure to Hulk smash that thumbs up button before you go, please. Check out the description to get into the waiting list for the private financial independence group that's going to be opening up soon, as well as some resources and playlists to help out with all of your personal finance and investing needs. I'll see you in the next one, friends. Done.